Good day to one and all. This is Dr. Sivaraman here. I'm extremely sorry that there was a problem with regard to the hotcom. Hope you are able to hear me now. Okay, fine. Let me display the PowerPoint presentation. Tracking the forex market together, part 1. I was supposed to do it around 8 GMT. Now we are doing it around 10 GMT now. So anyhow, I'll explain the concept. Sorry for the inconvenience caused to the of the visitors. So I'll go to the next slide. So in order to track the forex market, we use the live market code page. I have given the link for the same and also the session timing. So live price actions are very important according to our understanding, and we'll be able to track the market pip by pip movement, and also we'll try to identify the quantum of move and also the velocity of the move. Thereby we'll be in a position to understand whether it is a slow move or a quick move, and if it is a slow move, what they intend to do. If it is a quick move, what are their intentions. We try to read using a simple live market code page, and in that you come across the GMT time frame. Let me also give the link for the live market code page. Now with the help of the live market code page, you can open it in a browser and you can see the GMT time frame is given there. It is 10:11 GMT, but we follow the GMT time frame and try to identify the different sessions set by that of the players, and they have the three following sessions, namely session 1, session 2, session 3. For our convenience, we can call it as a Japanese session, European session, and US session. So now we are in the European session from 7:30 GMT to 13 GMT. We are in the mid session, 10 GMT. From 11:30 to 13 GMT will be the late European session. So during the mid sessions, the players handle the crosses. During early and the late sessions, they handle the majors. So that is how we identify how exactly they are handling the respective pairs. Now, in the live market code page, what you are supposed to do, I have given the link there. We note down the high, low, and the net change in the 4 majors and 2 commodity pairs, which are set around 2:30 to 3:30 GMT as the initial low and the high, and they are used as the reference levels by that of the players, and then they try to take the market either on the upside or on the downside in order to create the continued uncertainty in the market. So only by creating uncertainty, the players are able to induce the traders to do the wrong trades, and once the traders take the wrong trades, they forcibly close the positions and incur loss. So that loss becomes the profit for that of the players. So since the players have got the huge money to play around in the market, so invariably they are able to create the market sentiment and act against that of the traders. So when they create the bearish sentiment, the traders also initially hesitate to become the bearish traders of doing sell and buy trade after the drop. But if they continue to drop, the traders think that, okay, what the charts indicate is right, the market is going to endlessly fall. Probably euro could reach 0 or maybe out of the currency, and then they take sell positions. Then after about 2 days, the players gain the levels using some other story, and then the traders are forced to liquidate. After the rise, they try to take the buy position, thinking that the bullish tone is set in the market, so it may continue to rise. Then once the traders accumulate long positions, the players drop again, telling some other story, and as a result, the trader has to lose the money. So ultimately, if you follow the market sentiments and try to trade, then it may appear that they are giving the profit, but ultimately they take bigger loss from us. So in order to understand read the intentions of the players, so what we try to do is track the traders track the players, how they are trying to do the moves and how they intend to make the moves. So it is more of tracking the players' moves in the market. How exactly we can do this? So you come across in the live market quote page. Let me focus the camera over that of the live market quote page. The live market quote page, you find that the bid ask are given, and also the high and the low set for the day, and also the net change. Then the GMT time frame is given. So when they just make the drop, you find the low is set. Afterwards, when they breach the high and form the new high is set, and you are able to see current levels where the market is. So currently euro is trading around 1.227476. It went up to 1.2296. Similarly, in the case of JBB, it went up to 55.71 and resting around 55.64 now. 55.13 is the low. 47 positive net change is seen. That means from yesterday close level, GBP has gained about 47 pips, Euro has gained about 25 pips, and Australian dollar has gained about 59 pips. You know how bearish the sentiment they created yesterday and how they are trying to rise the market. When the traders liquidate the long and turn short, you find the market is bouncing back. Then immediately, technically, we try to find out where the first resistance, second resistance, third resistance in order to take further sell positions so that we'll be able to book profit. When they drop, then we find that the players have changed the market sentiment. So this is how you find currently you come across Euro, GBP and Australian dollar showing positive net change, USD USD CHF and USD CAD are showing negative net change. That means all the majors and the commodity pairs are showing the USD weakening move. So you know that mid sessions they handle the crosses. You find some of the crosses they have made big moves, and all other yen crosses yesterday they made the drop, and euro yen has come to 97. And when the traders thought that okay, below 100 is a good level to buy, they made further drop. How they had done? Dropped euro, dropped USD yen, telling two different stories. And then later on, euro yen and GBP yen dropped, and GBP yen to 123 area. And now you find that USD yen is making lesser drop, and euro and GBP are gaining more pips. And during the course of the European session, late sessions, you will be able to see USD yen also they will try to rise and rise euro yen and GBP yen and all other yen crosses. So this is the play. They try to do it on a daily basis, and we call it as bullish, bearish, and so many economic factors are responsible for such moves, etc. So ultimately, we have to track the players and try to trade along with them. It is difficult to trade against them. Now, in the live market quote page, we find the high, low, and net change around 3:30 GMT. So I have noted down today, 3:30 GMT, the initial lows and the highs, and I will now explain to you where the current levels are. You can just look into that of the live market quote page in your browser, and you can see that 1.2247 was the initial low in the case of euro, 1.2266 was the high. Currently, you find that euro is trading around 1.2277. It went up to 1.2296. So they have just breached the initial high and staying above there for more than 30 minutes to 2 hours. So slowly they are gaining the levels. It is an intentional move. Intentionally, they wanted to gain the levels during the US session. Also, they intend to make the gains, because when they stay above that of the initial high for more than 2 hours, we understand that they wanted to rise throughout the day for 2 sessions, and the start of the third sessions, they are expected to gain the levels, and we can easily do a trade once you find that they have reached more than 2 hours, staying above that of the initial high, and they are not expected to reverse during the day. You can take it as a thumb rule now and just watch through the day whether they are dropping euro or rising it. Now, in the case of JBB, 1.5513 is the low that they are not breached it, and 1.5531 was the high around 3:30 GMT. Currently trading around 1.5563, 1.5571 is the high. So any dip in the case of GBP again, we can take a buy, or even the current level we can take a buy, and definitely they are expected to gain the levels as they are doing it as an intentional move because they breached the initial high during the close of the Japanese session and started holding above that of the initial high throughout the European session. They are not dropped it. Now it is 10:20 GMT still. They are not dropped it. 2 hours passed from the start of the European session, 7:30 to 9:30. So definitely they wanted to make an intentional move. That means continue to rise for the next session also. In the case of USD Yen, 79.25 was the initial low. They breached the low and formed 79.22, their nominal downward move, and 79.44 is the high that they are not breached, and now currently trading around 79.27, above that of the initial low. So they made a brief 3 pips downward stop and they started gaining and holding above that of the initial low, and they are expected to breach the initial high and go above. As I explained that during late European session, they wanted to gain levels in the case of Euro GBP as well as USD Yen, just to do the move what they had done yesterday. That is dropping Euro GBP and USD Yen during yesterday in order to drop Yen crosses. And today they wanted to raise all the three with the three different stories, and then you will find that all the three coming to that of the positive net change. As a result, Yen crosses are expected to gain along with that of Euro GBP as well as the Yen. Now in the case of USD CHF, you know that they are taken it up to that of 97 area and also showed 98.06 as the high, and they are not breached the high. Whereas in the case of low, 97.90 was the initial low, and they just breached and formed 97.68, and currently trading around 97.81, still below that initial low. When they hold below that of the initial low for more than 2 hours, that means they wanted to make intentional downward move in the case of USDCH. Opposite to that of Euro gain, they are expected to slide. In the case of USDCH, probably they may come to that 97 area or 97.15 or 96.86 and things like that below the psychological level, and then start reversing it. In the case of USD CAD, where the stops are there, they will try to attempt and fill the stops and then reverse it. So there is no question of that any support and the resistance. If you think that any psychological level is a support, they will breach. Any of the pivot point as a support, they will breach. Or if you think that it is a third level support, it has to come exactly to that level and go. Probably they may not visit at all. So that is how they just make the moves in the market. So however precisely we try to take trading decisions, the players are to just demoralize us. In the case of USD CAD, 1.0211 is the low, and they breached, low, and they breached the low and formed 1.0193, and the high was 1.0231, and that they are not breached it. So you can understand they have done the downward stop, and in the case of USD CAD, but staying below that of the initial low, 1.0211, current level is 1.0195, and 31 pips negative net change is seen. So USD CAD might make about 20 to 30 pips dip. And normally the volume in the case of USD CAD is lesser when compared to that of the other pairs. So they just make a downward stop and then tell some other story and make an upward stop. And today you find the trade deficit, which is going to be announced. So probably they may use it as a trigger and make a downward stop and as well as upward stop in the case of USD CAD. Then Australian dollar, 1.0179 was the initial low, and they are not breached it, and the high was 1.0213, and currently they breached and formed 1.0262 and holding above that of the initial high, and currently trading around 1.0256, quite 7, so above that of the initial low. So here you find when compared to that of the 330 GMT what they are set. In the case of Euro, GBP, they have breached the high and staying above. In the case of Australian dollar, also they are staying above. But in the case of Yen, they just made a downward stop and come above that of the initial low. And in the case of Uh, CHF and Canadian dollar, they just breached the initial low and staying below that. So what sort of trading decisions we can make it? So let me minimize the PowerPoint presentation and focus the camera over that of the other slide. So after noting down the net changes and the initial lows and the highs, then we watch the market whether it is closer to low or closer to high. And when it is in the middle level, in between the low and the high, we simply relax. When they come closer to high or closer to low, we'll try to take the positions. And also closer to that of the initial high. Today they breached the high and stayed above that of the high. So we know that the initial high, when they come closer to that of the initial high, we can take a buy position and do it as a technical trade. And they are expected to continue to rise because they have stayed above for more than 2 hours. Then majors are active during that of the early and late sessions. Then crosses are active during that of the mid sessions. So identifying the type of move is very important. As I explained many times, that stop and the false moves are the moves which happen in less than 30 minutes. And so if they just go above that of the initial high, yesterday during the Japanese session, you would have noticed that they went above that of the initial high, came down in less than 30 minutes, then started making the slide. So if you identify they had done only a stop and on the upside and come below that of the initial high, we can immediately take a sell position and they are expected to drop. There is no question of sentiment attached to that of the currency pairs. So we have to identify whether the players are expected to make a drop or rise on a daily basis. So that is why many of the traders nowadays started asking in fxtrade.net chat whether it is a buy and sell day or a sell and buy trade day. So that is how they wanted to identify the days as sell and buy trade days or buy and sell trade days. And they do not want to learn anything about that of the market. And they want to do whether I can do a buy and sell or a sell and buy. But ultimately to identify what the players are trying to do, it was very important. If you don't understand that and if you try to trade as per somebody else's expectations, then when the market goes against, you will start yelling at those persons. And ultimately you will be losing your money. So that is a wrong approach. Instead, you have to develop a system gathering information from various analysts and try to find out which is working for you, which way you are able to perceive the market correctly, and then try to trade upon it. Then the stop ends and the false moves are moves which happen less than 30 minutes. False stop end is the one which goes above that of the high or below that of the low and reverse in less than 30 minutes. False move is the one go up to that of the high and reverse or up to that of the low and reverse. They are the false move. The extended move is the one they just go above that of the high and stay there for 2 hours and reverse. That's what I was telling you. And they are staying more than 2 hours. If it is more than 2 hours, it is an intentional move. They go above that of the high, what you see today, and continue to cut the new high or new low more frequently beyond 2 hours up to 2 sessions and reverse during the early third session. So till such time, they are expected to gain the levels and they cannot continuously rise or endlessly rise or drop. They have to reverse the market. They are all called intraday reversals. So we have to identify by looking into the type of moves, then we can relax and try to trade without any ambiguity. So ultimately, all the type of studies and analysis are being taken into consideration in order to reduce the uncertainty, in order to bring down the gap in the uncertainty. Thereby, we are able to take certain decisions and try to take trades. So in order to avoid the uncertainty and also not to risk your equity during uncertainty, we can use hedging. So hedging is the product or the provision available in the trading platform. And if you have got a buy position and against that we can take a sell position and the positions will not offset each other and in the same pair. And that is referred as hedging, and that is available in the European or Australian trading platforms and some of the Asian platforms. and not in the case of US platforms. So you have to understand that, and if you want to use the hedging as a tool and effectively use it in order to minimize the loss and maximize the profit, then you have to identify the type of platform which is offering this hedging and learn fully how to handle the hedging. It is something like in a car when you are driving, we use the accelerator as well as the brake. Both are important. If you don't use the accelerator, the car will not gain the momentum. And similarly, if you don't apply the brake, you will not be able to stop the car where you intend to drop or intend to stop the car. So both are equally important. It is something like the speed of the platform as well as you need to have the brake. So when you have the provision to apply brake, it is something like the hedging. So immediately when the usable margin is getting eroded, you can just take a position opposite to that of your original position. Thereby, the equity erosion is stopped to start with as an emergency, as a crisis management, if the hedging is there in the platform. Otherwise, as soon as you take that position, you can keep 30 pips below a hedging order so that when the market drops suddenly against your expectations, and you can simply hedge the positions and then wait for the market to see whether the hedging is making profit or loss. Accordingly, you can just handle the hedging. So before going to that of the hedging, I wanted to decide with regard to the entry. So how exactly you can take entry during the start of the market? You have to identify. So 7:30 European session starts. So by 8 GMT, we will be able to know whether they are done the stop end or they are making a false move up to that of the high or gone above that of the high and staying above there for more than 30 minutes to 2 hours. And so we identify whether it is an extended move or an intentional move. So it is above that of the high. Today they have done the intentional move, staying above there for more than 30 minutes. And then when they are staying above that of the high and the new high, and not new high is breached, then we can try to take a buy position near that of the initial high and try to book profit when they breach the new high and go above during the late session. Exit. So whenever there is a quick move in favor of us, and quickly when they go up to that of the high and breach the high and go above, see whether it is a stop and continuation of the intentional move. During the session change, whether they wanted to make a false dip and before making further rise, you can identify that and quickly close the position within the session. Because once they set the trend in a session, normally they continued with the trend in that session. During the start of the session, they make the swings in order to create uncertainty. Later on, they set the trend in the session. The next session, they will make the swings, that we call it as a consolidation, and then set the opposite trend or the continuation of the trend. That is how they try to do it. And depending upon the traders taking positions, they make the moves. So they are not philanthropic in giving profit to every trader and tell them that, come on, you take a buy, I will rise the market, you can book profit. They are not here to do that. They will say, come on, you take a buy position, we intend to rise, giving so many other signals and pretend to appear as if it is, as per the chart, it is going to go up. Then later on, they make a big drop, and then they will simply say that Fitch has downgraded this. Simple. So we have to understand what they intend to do. So identify the type of moves, and the moves will indicate what is going to be the next move, and accordingly you have to book profit before going to that of the next session. So in case if it is hedged, because many of the people, when it is hedged, they feel that they are struck with their positions. It is not really getting struck with the positions. It may be an unpleasant situation in trading, but as far as your equity management is concerned, you are really prevented your usable margin to get eroded just like that when the market is going against. And you will be seeing it and become stunned, and the usable margin will come down from $5,000 to $4,000, $3,000, $1,100, Come on, margin call, that's all. So you cannot just like that watch it without taking any action. So it is something like somebody is flicking a purse from your pocket and you are just being a witness for it and you say nothing. So nobody will be like that. But in trade, we become stunned and surprised and avoid using the hedging because the main problem is if the hedging is used, many of the traders got the inhibition. If it is hedged and the market reverses, I am struck. That is why they avoid using the hedging. But that also leads to another condition. They do not want to book loss in any trade. Because if it is hedged and if the hedging makes about 5-10 pips loss, they do not want to close it with a large loss. They want the hedging to make profit and afterwards they wanted to close and the market has to go up and the original position has to make profit, then they are happy about it. They are not willing to close the hedging with a loss. So that is another factor for not using the hedging. But if you use the hedging, then if you are able to get convinced that hedging is really a money management tool, then keep 30 pips away from that of the market, a hedging order. And if the market shows a profit and loss or continue to show loss for 30 minutes, then try to keep stop at entry in the hedging or close the hedging with 1 or 2 pips loss or with a profit and keep another 30 pips below another hedging order. Thereby what happens, when the market goes up, you are not hedged. You can raise the hedging order to that of the original level and continue to hold. So it is a risk management technique. So ultimately we are all coming here in the market and pray for euro to go up. Why? Because you have got a buy position. You want your buy position to make profit. Not that you have got any affinity to that of eurozone. You might be belonging to different countries. So we have to understand why our mind is behaving like that. And so ultimately what is more important for us? We want the euro to go up. Doesn't matter. Fine. Still, we do not want our money to go up. Or our money to evaporate. So we have to use the hedging effectively so that our money does not evaporate just like that when the players are making big moves in the market or playing a trick in the market. Then, if the hedging is filled and if the market is making big moves against you, like yesterday they had made a big drop to all-time new lows and things like that, and whenever they show all-time new low and things like that, or 2-year low, 3-year low, in the case of Japanese yen we have seen, in the case of other currencies also, in the case of CHF we have seen 0.71, and they show such levels, but the market does not stay there forever. They show such levels in order to trigger the fear. So if you become frightened, then we will not be helped by anybody. So if they show such levels and understand that, okay, I will keep stop at entry in the hedging, let them drop even to 1.19 or 1 or parity or parity, no problem. I have a hedging order and the hedging order is making profit, I will keep stop at entry. I will not, like a fool, do a sell and buy trade at the bottommost level because it might give 10-15 pips profit technically, but if they suddenly reverse, I'll be caught wrongly, and then my mind will say that do averaging of during the rise, sell during the rise, the same thing. You will accumulate more position, it will lead to over trading, and ultimately what you have earned a small profit during that of the downward swings, all will be lost in one single trade on the upward move. So there is no point in doing a trade of that nature, coming back to the zero level where you have started with $5,000, continue to earn $10, $20, $30, $50 on small downward swing trades and lose about $500 and one upward move. This is of use. Then if you are using the hedging, either way trading can also be done. When they drop like this and formed all-time new low, fine, that's a great opportunity because nobody would have thought that I can do a sell and buy trade during such a drop, and you have already got a sell position, you can book profit in that. Keep another hedging order below that in order to prevent further erosion of the usable margin. When you book profit, your usable margin does not get eroded. And when they start gaining the levels in the market, you can just continue to raise the hedging order to limit the risk or reduce the risk until you are able to keep stop at entry in your buy position. Then afterwards, trail the stop in the buy position and maximize the profit during the upward move. So this is the basic trading strategy that I explained to you. Now, with regard to the trades, as I explained that we are supposed to do the buy and sell trade, and because of the change in the time frame, already euro has gone up to 1.2284, closer to that of a high. The initial high was 1.2266, around 1.2270 if you take a buy position, because that was above that of the initial high, and the market euro stayed above that of the initial high for more than 2 hours. So they intend to make an intentional move on the upside. So anyhow, 1.22. Currently it is around 83. I'll keep 10 pips below. During a small swing, they might be able to fill it. If I'm lucky enough, I might be able to get that. But still, I will not blindly take a buy there. I'll keep an entry stop 30 pips below. So entry stop will be at 2243 and 2273, just 10 pips below that of the current level, 1.2283. I'm taking a buy because it is above that of 1.2266. That was the initial high. That is the main reason I am taking a buy, because I could have taken around 1.226667 when they are holding above there for more than 2 hours. But I was talking to you, and then now they are gained to 1.2283. So a small dip from there, they could make it. A small swing is part of the game. So 10 pips below, I'll keep it. And if it is not filled, I'll modify and take it at the market. Otherwise, if they fill it, I'll keep it. Still, the hedging order will be protecting me, and it will give only a risk for 30 pips. Then in the case of GBP, 1.5562 is the current, 63 is the current level, 1.5571 is the high. And in the case of GBP, 1.5531 was the initial high, and so I'll try to keep 20 pips below that of the current level. You know that GBP is a currency which they normally make quick move, up and down move easily, because it is a less traded currency when compared to euro. In order to create the sentiment, they will prevent as if quick drop is going to happen in the market by dropping GBP, and quick rise they make it in GBP when the euro is struggling to rise at the lower level and change the sentiment. Today, you know that GBP was the first one to rise. Euro was holding around 1.2267 for a long time. So that is how they pretend most of the time. So we should not get convinced with regard to what is visible in the market is not true according to me. So I'll keep the hedging order. $5513 as the entry stop. Then in the case of Australian dollar, because I'm just giving the calls with regard to the numerator currencies, the denominator currencies are not expected to make big drops now. They are expected to make only sideways moves, and numerators are expected to gain. Whenever they keep sideways moves in the numerator, they will gain quickly in the case of denominator currencies. So if you consider the fall in the case of euro, the rise in the case of USD CHF will be more. So I recommend only buy and sell trade in the case of the denominator currencies as well. So in the case of Australian dollar, 1.026669 is the high, 1.0266 is the current level, 1.0179 is the high, but morning high was 1.0213 during the Japanese session. So I will try to keep around 20 pips above that of the initial high, 1.0232, because it is closer to high. And if I buy it, if they don't breach the low, they will make one dip of 20-30 pips before making further rise in the case of Australian dollar. They have to rise and dip alternatively in different currencies in order to handle the crosses. So I just take a chance only when they hit my position limit orders. So they are all entry limit orders. So I'll keep the hedging order. So they are all limit orders. No, they are not positions. They are all limit orders. I kept it, and if they fill, they'll become positions. I'll write here limit. So let me minimize the PowerPoint presentation and take up the questions which are asked here. So I'll give you the fate of these positions. You can also enter in your demo trading account and see what happens to these. Whether they are filled, limit orders are filled, in case if they are filled, whether they are hedged, or in case they are filled, afterwards they are making profit. And our reading is they have made the intentional move, they are expected to continue to rise. That also you can just find out whether it is happening. If you get convinced that the type of moves are specific and they don't alter the type of moves, then you can make use of that for your market trading purpose. So let me answer to the questions which are asked here. Rayman has got a question. What is the maximum leverage you recommend? What maximum open positions of the same time? For example, 100K USD account. Okay. As far as the leverage is concerned, the more the leverage, say like 1:200, 1:400, then the usable margin they are expected to take is very less. So if it is 1:200, they might take about $500 as the usable margin for one standard lot positions. If it is 1:400, they will take only $250. But it might appear for you, okay, we'll just only pay $250 and take one standard lot and try to trade. But more the leverage, you will be tempted to take more positions, because after all $50, I got about 100K, only $50 is given to take one position. Let me accumulate about 5-10 positions, because each will take only $50, then you accumulate 10 positions, and in 10 positions you will be giving about $2,500 or $3,000 or whatever it is. Then later on you realize when the market goes against you about 300 pips, all the positions making loss, and every position will be taking $10 for 1 pip. So 10 positions, $100 for 1 pip move on the downside, and your 100K account will go in for margin call. So if you do not estimate that leverage is one of the tools to stimulate the traders to do over trading, and the traders lose money in the market only because of over trading, nothing more than that, because the players can make big moves in the market, but still they cannot come to your computer, or they cannot put the hand through your terminal and say that, come on, you close your position with loss. Nobody can tell that, and nobody can do it. Only you are forced to do it on your own out of fear or out of over trading. So if it is a 100K account, then it is ideal to go in for 1:100 or 1:200 maximum leverage. Still take only one lot at a given time and try to book profit using the hedging. Make profit on either way moves of the market. You will continue to make it into 200K in a matter of about 3-4 months if you take only one lot at a given time. If you try to take, because I have got 100K, so let me take about 5 lots positions, or each time 5 lots, and I will make partial profit booking in 1 or 2 lots and then maximize the profit in 1 or 2 lots. All theoretically may work well. If the market goes against, all the positions will take away your usable margin in a very big way. Always expect the unexpected. How we are going to handle when such unexpected things happen in life? Then you will find that nothing can surprise you. Then Scooty. If over 30 pips hedging is filled and we changed it to 60 pips. This is also reached, means what is our next move? Okay, you keep the 30 pips hedging order and then market fills the 30 pips hedging order. Then afterwards you close it with stop at entry or with a nominal loss, thinking that it is only a stop and, because you only read it as a stop and move, during which you are trying to take a buy near that of the low and keep 30 pips below a hedging order. And if they hedge you, you understand first that it is due to stop and they have filled your hedging. Then subsequently, if the market goes above that of the initial high, low, and stay there, you find that the hedging is making loss. So in 30 minutes time frame, when the hedging is making about 2-3 pips loss, you try to close it and keep another hedging order. But they go up to that of the low and start making a drop and hedge you second time. Then you are blocked 60 pips. Okay, what is the type of move they had done? They just stayed below that of the initial low for more than 30 minutes and come down and hedged you. That means you have to wait for 2 hours for them to complete the extended move. Only then you can close the hedging with a profit. Hope you are able to understand. And in case if they continue to breach the new low and go below, then you know that they are doing an intentional move on the downside. I'm not going to book profit in a hurry. On the third session downward quick drop, I'll book profit and then they will start reversing it. You know, yesterday your session, they made a quick drop in a euro, 1.2237 they showed, and then started gaining the levels, and today's low is 1.2247 and they are gaining it. So if you book profit during such quick drop and keep 30 pips hedging order below that, you will not be hedged, and if they gain, you can move the hedging order upward, and until such time you are able to keep the stop at entry in the buy position. So ultimately, reading the type of moves they are doing is very important. See, why I'm insisting upon reading the type of moves? Because they make such moves in order to pretend and in order to trap the traders. So first they pretend, then subsequently they trap the traders. And also this pretension and trapping comes depending upon the holding positions of the traders. They get the inside information. Based on that, no fool will sell at when euro is below that of 1.23 or 2259 and 69 in huge quantity. No, in case somebody buys and reverses the market, they will be trapped vulnerably. They will come to street. A billionaire will come to street. So when they are deploying billions and billions of dollars in trading in different markets, they do not want to take atom of risk, and they do not want to come to streets because their expenses are very high on a daily basis. They cannot change their lifestyle. So obviously what they do, they want the complete inside information with regard to the traders and how they can be trapped, and then make a quick drop telling some story. So the same Eurozone story, you will see whenever they want to drop euro, they can use it. And otherwise, they can rise euro like today, and they won't talk about Eurozone story. So it is a question of whenever they want, they will just plug in and use it as a story for us to get convinced. Nothing more than that. So that is how you have to handle the trade, identifying the type of moves while the hedging is being handled. Okay, B-man. At what size should this trailing stop be profitable? Trailing stop of 15 pips is fine, and if you want to keep a slight away from that, 30 pips trailing stop is fine, provided the market is making very good momentum. If it is very sluggish and making slow moves, then 15 pips is fine. They will not even hit it. I kept 10 pips below that euro, the buy limit order. They are not filling it. So 15 pips trailing stop, they will not fill it. They will slowly gain the levels. Luzon Ferry, the part on hedging to protect the positions was more enlightened. Okay. Ultimately, you may not know how to trade, and you may not be a versatile trader and you would not have learned the art of trading, whatever it is. But the first thing to learn is avoid blowing up of the account. So, whenever you try to learn the car driving, the first thing the instructor will tell you is this is the brake you have to apply in the event of you want to stop the car. Then only you will teach about acceleration. So you need to know how to arrest the erosion of the usable margin. Then Moses. So the entry stop is the hedging order going opposite direction of the initial order. Yes, you are right. So that if you have a buy position in euro, we will have a sell position as well as a hedging. Thereby, our usable margin will be blocked only to the extent of 30 pips. Let them drop even 300 pips, we will not be affected. When you find that market is not going to reverse, and as others are telling that euro is going to parity, then you simply close it with 30 pips loss. The original position with the hedging. So such a convenience is there when you are using the hedging. And that is the main reason that they eliminated hedging in US platform. Because all are taking a conspiracy against that of the traders. To learn your method thoroughly, which is support service, do you still have a course? Yeah, I do provide the course, but I do not want to talk about it in a public forum. If you contact me through email, I'll certainly explain to you. Then, because I do not want to use the particular webinars for marketing purpose. Listen, mitigate risk first. Profit will come. Yes, you are right. Then let me go back to that of the PowerPoint presentation. No more questions. So these are all the orders I have placed. Still, they are not filled it. But you can keep the orders and see whether they are filling it or not. If they fill, it is fine. At least you will be able to understand intentional move when they are just above that of the initial high for more than 2 hours. They will continue to rise during the third session. Start of the third session. You will be able to understand that. So you will also able to see how systematically the players are making the specific type of moves. And these are all the only 4 type of moves they do. During trend reversal, they make extended moves. Like a very quick drop of 150 pips and reverse it on the next day. And that sort of moves, they do it during that of the trend reversal during first week and the last week of the month. Other than that, they only do these 4 type of moves. Besides, they make small swings between low and high during the mid sessions. So simply, if you watch the live market quote page without even taking any positions and try to read what type of moves they are doing it, you'll be able to see that they are doing it in sequence. So first of all, a downward stop and followed by that a swing up to that of the high, then a false move, a small dip, then go above that of the high, make an extended move and continue to rise and intentional. So they are all coming sequence. Afterwards, a stop and then an extended move on the downside the next day. Then afterwards, a swing between the low and the high. Then intentional move on the upside the next 2 sessions. So they continue to make the moves of that nature, and you don't require any chart to prove that. You can just watch the live market quote page and you can understand, okay, this is the price from where they are triggered and this is the high they have set and gone above. Okay, they are going to rise. I'll make a buy and sell trade. Or if they just gone below that of the initial low, staying below that of the initial low for more than 30 minutes, then I'll take a sell there. Definitely for 2 hours, they will make a drop. I'll finish booking profit on the downside. So it is not that becoming bearish and trading, identifying the type of moves and quickly grab the profit during the moves. So the approach is very essential. For that, you have to be unbiased and read their intentions. That should be your objective. Protecting your equity is the primary objective. Then try to read the player's intentions is the secondary objective. Then capitalize such moves. Then I will come back by 14 GMT and give you the outcome of the trades, what I have proposed during the European session, and also take the positions during the US session. And I'll also explain how exactly they had done the intentional move on the rise. And you might think that I am a great forecaster and things like that. It is not like that. It is a question of reading their intentions. No, if you read other men's intentions, you become a successful businessman. You know that. That is one of the business tactics. So you just read their intentions because the players are against us. So we need to read their intentions and smartly overcome and try to capitalize their weakness and capture our profit. So we'll see again, review the market by 14 GMT and see where exactly they are taking the market. So I'm explaining only the market reading technique and the trading strategy here, no forecast. So we don't require any forecast for intraday trades, especially session-wise trades, and read their intentions and take a trade to earn about 30-40 pips. Calmly do it and use the time frame and try to close the trade. Don't carry it for a long time. Close the trade within the session, so that if you are free during European session, on a daily basis, you can do trades only during European session. You need not keep awake during midnight and things like that, slog and still lose money. Okay, see you by 14 GMT. Thank you, one and all.